The credit card bubble in America is on the verge of popping. And the way we know this is because the credit card default rates are skyrocketing right now. People have stopped paying their credit card bills. They're getting sent to collections, and this is an ominous sign for the US economy. With credit card delinquency rates surging to the worst on record in a new Federal Reserve study. This study, conducted by the Philadelphia Fed, showed that almost 3.5% of card balances were at least 30 days past due, with the percentage of people making the minimum payment on their credit cards also spiking to a series high, indicating a huge level of consumer stress in the economy that's going largely unreported in the mainstream financial news, which is causing lots of people to mistakenly believe that the economy is healthy. Something that a lot of people mistakenly believed back in 2007 and 2008 before the last big crash. Because you can see 2007, 2008, that was the last time that the charge-off rate on credit card loans from banks was over 4%. You can see that in the fourth quarter of 2023, it was a 4.2% charge-off rate. That was the highest rate we've seen since right before the worst recession we experienced in the last 80 years. Now, of course, surging credit card default rates does not automatically guarantee we're going to see the same type of downturn that we saw in 2008. However, it's got to cause you to stop and really think about what's going on under the surface of the US economy. Because when we see so many people stop making payments on their credit cards, that's a signal that people's income and wages are not keeping up. And not only that, it's a signal that the inflation and the cost of goods and services, it's increasing faster than wages. And ultimately, that's why people end up taking out a lot of credit card debt. With CNBC reporting that credit card debt hit a staggering 1.13 trillion earlier this year. That credit card debt is now at the highest level of all time, approximately 20% higher than it was prior to the pandemic. And so we have these higher credit card balances that people are carrying, over 1 trillion across the economy, and these higher balances are now combining with surging default rates. And that's a bad sign. That's a signal that lots of consumers and Americans are really starting to get behind, that the wall of debt is getting so big that they can't pay the bills anymore. But not only that, that's occurring at the same time that the interest rates on the credit card debt are also surging, with the commercial bank interest rate on credit card plans spiking all the way to an average of 22% in the beginning of 2024. You can see that this is way higher than it was before the pandemic, and actually the highest rate of credit card interest in 30 years. And what I fear is happening now is that this combination of factors is crushing American households. So many households in America, they got used to spending at a higher rate during the pandemic because the government sent out all those stimulus checks. And now because those checks are no longer there, they're transferring that spending to the credit card. And a lot of them really don't know what they're walking into. And what I think will happen at some point, everyone, is that the consumer is going to break. The consumer won't be able to pile on more credit card debt. They can't take more interest, and they're going to have to cut back their spending at a certain point. And when that happens, that's when you'll finally see the things you would expect to see during an economic downturn, a surging unemployment rate, stock market crash. It's going to be tied to the consumer finally cutting back on spending. But so far, the consumer hasn't really cut back on spending. The consumer is still actually using this credit card debt in the short term to sustain the spending levels in the economy and give the impression that everything is all fine and dandy. And you can see that by looking at data on retail sales. This is very important data for you to look at if you want to understand the trajectory of the economy, how much money people are spending. Well, what do you notice is that retail sales plummeted during the first couple months of the pandemic, but then they quickly rebounded and got back to trend. Then in March 2021, when the third stimulus check went out, spending spiked. And then it continued to grow through early 2022. But take note of what's happened since then, everyone. Spending is kind of flatlined a little bit. It really hasn't grown much over the last 2 years. In fact, nominal retail spending, which includes online e-commerce, has only grown 3.3% over the last 2 years. And so it's not so much that the spending is booming in the economy anymore, everyone. It's actually slowed down considerably. However, it's slowed down to a still very high level that's being supported by record amounts of credit card debt. But you know what actually really scared me, folks? Is I decided to dig in a bit deeper here and look at the credit card usage and the credit card default rates by card issuer. by the different banks and the different card companies that issue these credit cards. And what I found shocked me when I dug into some specific ones. You can see, everyone, these are the biggest credit card issuers in America. This is who's issuing the credit cards and who's funding this credit card debt bubble. And the one that really shocked me, everyone, was Discover at number 6. They're the number 6 credit card issuer. And what I found in their financial statements, oh boy, you guys are not going to like it. Discover just announced their earnings for the first quarter of 2024. And in their earnings supplement, they have some interesting data on credit card delinquency and charge-off rates. And if you go here to credit card loans and then to net principal charge-off rate, what do you notice is that the charge-off rate in first quarter of 2024 was 5.66%, meaning 5.66% while their credit card loan balances were being written off as uncollectible. Now that charge-off rate of 5.66%, it was nearly double the charge-off rate of 1 year ago of 3.1%. It nearly doubled in a year, which is wild, everyone, because everyone's telling us how good this economy is, right? The GDP growth the last year was good. The unemployment rate is still really, really low. Yet one of the biggest card issuers in America reported a doubling in their charge-off rate. And what's wild is I actually went into Discover's old financial statements and I pulled their charge-off rate for the last 15 years. And here's what I found. That this 5.7% charge-off rate in the first quarter of 2024 is the highest that we've seen since, once again, 2008, everyone. So entering the third quarter of 2008, right before Lehman, Discover's charge-off rate was 5.3%. And again, a charge-off is when a bank deems unpaid credit card debts as uncollectible and writes them off. Well, they were 5.3% right before Lehman. They're 5.7% today, which is way higher than the pre-pandemic norm and is suggesting that this is a deteriorating situation for people who are spending on their Discover credit cards, and that we could be seeing something like we saw in the GFC, where this charge-off rate eventually skyrockets to something like 8 or 9%. And again, folks, I just want to be really clear about what this means. This doesn't mean that, like, right now we're seeing a repeat of the great financial crisis. Rather, what it means is that we're seeing a lot of the same things happen that we saw in the beginning of the great financial crisis, particularly people overspending and not being able to pay their credit card bills. And what was alarming is that as I dug into more of the data, it wasn't just Discover, it was also with all the other card issuers as well. As Wells Fargo, Bank of America, and JP Morgan, all of them are also reporting skyrocketing credit card charge-off rates. All of them are reporting charge-off rates now higher than pre-pandemic norms. Interestingly, the only credit card company to report charge-off rates that really weren't higher than pre-pandemic was American Express. American Express has a 2.3% charge-off rate. That is roughly similar to what it was before the pandemic. So we're not seeing as much credit quality deterioration with Amex card spenders, but pretty much everyone else, we're seeing it spike. And when a credit card gets charged off, like, that is not a good thing for the person who's holding the credit card. Like, when the bank moves to charge off the amount owed, they're saying, we do not deem this as collectible. We're writing it off and we're going to sell it to a collections agency. And at that point, the collections agency comes in, usually about 6 months after the debt goes unpaid, and that's when the collection agency starts pursuing the person who hasn't paid their credit card bills. And that can get really, really nasty, everyone, because the credit agencies pursue you, they try to collect. Sometimes they can even garnish your wages if you haven't paid at the same time. Your credit is going to get really messed up if you haven't paid your credit card bill and it gets charged off. So this is something at all costs to try to avoid, if you can, everyone, is overspending on your credit card and getting to the point where the bank sells it to a collections agency. Because at that point, it's a really tough situation and your credit score is going to get hit hard. But now, here's something even more interesting, everyone, that I thought was fascinating, is the fact that there's actually widespread variation across America in terms of where these credit card charge-offs and delinquencies are happening most, state by state. It's not as if everywhere in America is seeing people spend like drunken sailors on their credit cards and not pay the bills. We're seeing it actually happen in specific states. And what's interesting about this is if you look at the states that have the highest credit card charge-off rate, you can kind of start to make some predictions about the states that are likely going to get hit by the recession first, And they could also see a commensurate housing downturn, because if people aren't paying their credit card bills, well, that likely also means they're not going to be paying their rent and not going to be paying their mortgage interest. So watch out for the states where people are going delinquent most on their credit cards. And this was an analysis that Forbes actually just conducted. They posted an article titled, "These States Are Struggling the Most and Least with Credit Card Debt." They're reporting that credit card balances in the US have increased up to a staggering 1.13 trillion, and the trend shows no end in sight. While Americans nationwide rely on credit to help pay for everyday purchases, residents of some states are more likely to accrue debt they can't afford to pay off. To determine which states are struggling the most with credit card debt, Forbes analyzed data on credit card and delinquency rates from the Federal Reserve Bank of New York for all 50 states and the District of Columbia, and here's what they found. That the states here in purple, these are the ones that are struggling with the credit card delinquencies the most. And the one state where this is the biggest problem, everyone, is Florida. Florida has one of the highest card delinquency rates in America and also has one of the biggest year-over-year increases in credit card debt. Obviously, that's a concerning sign. Like, there's lots of people out there who think like Florida's economy is like the strongest in America, it's so great. Well, a lot of people moving there, or a lot of people that live there, they don't have enough money to support their lifestyle, the rent, the insurance costs, it went up way too much. And now they're putting it on the credit card and they're having trouble paying it. And I'm going to get into some more of those states in a second, because it's very important to understand where your state ranks in terms of credit card delinquencies and credit card debt, because this could be a key leading indicator of where the economy and housing market is heading in your area. But first, I want to talk about how like this data and this information, folks, like it's really not being widely reported on. Like there's some news articles out there that talk about it, but what I'm amazed at is how like this is not mainstream news. And it should be mainstream news. You know, the fact that Discover Financial is reporting skyrocketing charge-off rates that are as high as they were in mid to late 2008. I mean, that should be all over every single headline. But it's not. And that's concerning to me, because there's so many people who aren't being exposed to this data and information and being deluded into thinking that somehow this economy is on solid footing. And, you know, unfortunately, folks, it's not on solid footing. Surging credit card delinquencies is telling you the economy is not on solid footing. And ultimately, I fear at some point when this credit card bubble pops, we're going to see the reality of what's going on in the economy underneath. The fact that so many people are struggling with expenses after 2 to 3 years of inflation. The fact that so many people have negative sentiment on the economy. The fact that small businesses now have record low sentiment on the economy. I think those things will become more into focus once the debt bubble becomes unsustainable and pops. You know, the thing is, folks, though, we don't know exactly when that's going to happen. You know, bubbles and debt bubbles, they can go on for longer than anyone can think. This bubble has already gone on for longer than, you know, I was projecting, especially, you know, I started my recession calls 2 years ago. Clearly that recession that myself and so many people were expecting, it hasn't played out. But in fact, that almost makes me like more concerned about the current situation, because you know, we have a super low unemployment rate. The unemployment rate in America right now, it's 3.8%, according to the Bureau of Labor Statistics. And you can see this unemployment rate, it's been now very low for 2 years, and it's at almost like the lowest level of all time, this unemployment rate. And, you know, this is also supported by some other statistics as well. Continuing unemployment claims, yes, they've come up a bit, but at 1.8 million continuing unemployment claims, they're also pretty low. You know, they're not yet at recessionary levels. And so the labor market is still holding on. By and large, people, for the most part, still have jobs. But you got to ask yourself, well, wait a minute. If people, for the most part, still have jobs, and the credit card default rate for Discover is up to 5.7%, and Wells Fargo is up to 4.5%, and Bank of America is up to 3.6%. Well, what are these charge-off rates going to be in a scenario where the unemployment rate finally increases, right? Like, well, what's going to happen then when the unemployment rate inevitably goes up at some point? Well, these charge-off rates then, I mean, they could skyrocket just like they did back in late 2008, 2009, 2010. And so that points to the fact that there's lots of underlying risk in the economy that people aren't paying attention to. And that's important for you to know as a home buyer, an investor, or someone trying to track the stock market. Like, there's still lots of underlying risk that's starting to pop up. We're seeing cracks develop. Particularly in some of these states, everyone, with these high credit card delinquency rates. Like one such state would be Nevada. Nevada has the highest credit card delinquency rate in America, according to this Forbes article, at 13%. And more broadly, you could see that the areas in America that struggle the most with credit card debt and delinquency, where are they? Well, they're these areas in purple, primarily like in the Sun Belt. We talked about Florida, we talked about Nevada, also Texas really struggles with credit card debt and delinquency. Mississippi, Arkansas, Louisiana, South Carolina, and Georgia struggle as well. California also struggles. It's actually a lot of these Sun Belt housing markets that boomed during the pandemic. These are actually the areas where we're seeing the most distress pop up for consumers, suggesting that maybe potentially some of these housing markets could be ones to go down. I'll show you some data on that in a second. But first, what are the areas where there's the least stress in terms of credit card debt? Well, one would be Iowa. Another would be South Dakota. Another would be Oregon. Another would be Utah. We can see the Midwest and upper mountain states have some of the least credit card stress in America. A state like Minnesota actually has the least stress of any state. The credit card delinquency rate is 6.6%. That's half the rate of Florida. Because ultimately, everyone, I do believe there is a firm connection here between credit card distress and the US housing market, right? Because the credit card distress is telling you people are struggling, they're running out of money, they don't pay their credit card bill. Okay, well, what's the next thing they're not going to pay after their credit card bill if their financial situation continues to worsen? Oh, maybe it's their rent. Maybe they fall behind on their rent and then get evicted. Well, if that happens, we have more vacant rentals, we have big problems for real estate investors, maybe we have some forced selling from real estate investors. But take it one step further. Maybe people aren't paying their credit card bill because they can't afford it. Maybe eventually they're not able to pay their mortgage. Maybe they're not able to pay their mortgage and they go into default or are forced to sell their house prior to foreclosure so they can convert their house equity into cash equity. And the thing that I think is actually really, really interesting as we look here at data on Reventure app is that the states with the biggest increase in inventory and listings year over year, where are they? They're Texas, Mississippi, Alabama, South Carolina, and Florida. They're the states actually with the most credit card debt and the most credit card delinquencies. In particular, Florida, new inventory is up 57% year over year. And the one metric I would really encourage you to look at for your state, for your metro area, for your county, and for your zip code is that inventory surplus or deficit. This is a premium data point on Reventure app that shows you by zip code the areas where inventory and listings are spiking. These are areas likely where people are starting to struggle, where the debt burdens are getting too high, and there's now selling pressure in the housing market. So make sure to track that data on inventory and the inventory surplus for your city and zip code. Go to www.reventure.app right now and type in your city to see if the inventory is spiking and if people are running out of money and being forced to sell their homes. Because if it is, it's more likely that prices drop.